Hey folks, this is Jeff Camarda. Thanks so much for watching. I promised to be this an exceptionally short video. But one of the things that I wanted to emphasize, first of all, is, we remain in a bear market, as the Wall Street Journal noted pointedly last week. Until we surpass the levels last set, I think, in early 2022, we'll remain in bearish territory. Bear markets are, usually punctuated with what are called bear market rallies. Some call them dead cat bounces. But there's going to be normal volatility in a market, whether it's going up or down. Does it go straight up, goes up, and kind of up and down a little bit? And a downtrend or bear market, it goes down, then it goes up a little bit, then it goes down, then it goes up a little bit, and so forth. And we are still in a bear market because it's still lower than the high that was set just about a little more than a year ago. So just bear that in mind as you see normal fluctuations in our performance. And again, one of our really strong objectives is not only growing overall family wealth, but protecting it during bad times. And for my part, I still see some pretty significant storm clouds on the economic horizon. Inflation remains, pretty intractable. The Fed will probably need to consider additional rate increases. It's almost certain we'll see a recession this year. We have issues with China and Russia, and a lot of reason. And the federal deficit, is fixing to really set records not seen since after World War II. And don't forget Social Security and Medicare, the real linchpins of mainstream American retirement are on the ropes and likely to run out of money, in just a couple of years. I mean, it's inevitable they will run out of money. The question is when. But we're that close. We're just a couple of years away now. So again, we still are in bear market territory. A lot of folks are also concerned with risks in the U.S. monetary system. We've had a couple of bank failures. Charlie Munger, Warren Buffett's a long-time partner, really, at Berkshire Hathaway, over the weekend, I think, in Barron's, mentioned that banks haven't been at such high risk of commercial real estate loans since the 2008 crisis. So there's a lot of reasons to be concerned. And I come back to this during times of uncertainty in the markets, and by the way, it's just our opinion that we make decisions on in terms of investments. It's based on the indicators, as Kim famously says, at least famous around here. We make decisions not for what should be, but what is. We look at the trends and make investment decisions based on that. But we do, in some of the portfolios, have a lot of cash, and much of this cash is in a money market fund called SNOX, SNOXX, I think, which is basically invested in treasury bills. Treasury bills are they're government bonds that have really, really short maturities, typically 3 months or so. I think 9 months is the longest. They're government guaranteed, just like any other bond, any other treasury bond. And there are repo agreements where the Fed guarantees to buy out, so it's complicated. But it appears to be quite safe. We have a lot of our cash. Kim and I have a lot of our family cash there. But there is some concern that, gee whiz, if they don't raise the debt ceiling, if Biden doesn't sign the pending bill, and those bonds mature, but there's no money, can't write a check. So for those of you that are concerned about this, I'm modestly concerned, or mildly concerned, not really much. But we are exploring CD alternatives, FDIC insured bank accounts, basically. That we would be able to effectuate for you through TD Schwab. Obviously, we have the FDIC insurance is limited to a couple $100,000 a piece. It gets complicated, you got to leave a lot of them. And we also have the concern of CD basically is a term deposit where, unlike a bond, they do trade, but typically you're going to want to wait until the CD matures. We're looking at 1 month and 3 month CDs to give us some dancing room. Because again, regardless of what I think about the bear market, when we think we're in a bull phase, we're going to want to deploy in a portfolio to do this, that cash back into the market, and you may be shackled a bit with the CDs. So anyway, I guess this video didn't wind up being nearly as short as I promised at the beginning, for which I apologize. But if you're concerned about that and wish to explore, CD safe harbors with FDIC insurance for the near term, please reach out to your personal wealth advisor, ask them about that, and we'll do some one-off. It will restrict our ability to invest for you a little bit, but it may give you more emotional comfort. If you have interest in that, please reach out and we'll be happy to give you some details. Thanks once again so much for watching. Hopefully it won't be so long before the next one. This is Dr. Camarda signing off of the nonce, going back to my final Georgetown finals. 2 more and I'm done. And this is it. No more education. I'm going to teach from now on. I'm not going to learn anymore. Thanks so much. Bye-bye.